On August 14th, 2019, WeWork filed the paperwork for one of the most anticipated IPOs in Silicon Valley history. Within weeks, the company's valuation collapsed from $47 billion to less than $10 billion. Investors panicked. The IPO was canceled. Its founder was forced out, and the startup that once claimed it would elevate the world's consciousness suddenly looked like a company renting office desks at a massive loss. At its peak, WeWork controlled more office space in New York City than almost anyone except the city itself. SoftBank had poured more than $10 billion into the company. Celebrities praised it. Employees worshipped it. Analysts called it the future of work. Then the public finally saw the numbers. $1.9 billion in losses, $47 billion in future lease obligations, and a business model that depended on endless growth just to survive. But here's the part almost nobody understood at the time. This wasn't just a failed IPO, it was the collapse of an illusion. Because WeWork was never really selling office space, it was selling a story. And that story would eventually destroy nearly $40 billion in value. To understand what happened, you have to understand what WeWork used to be. The company was founded in 2010 by Adam Neumann and Miguel McKelvey in New York City. The idea sounded simple: rent large office spaces, redesign them with modern interiors, then sublease smaller spaces to startups, freelancers, and growing companies. But WeWork wasn't marketed as real estate. It was marketed as a movement. The offices had craft coffee, community events, glass walls, lounge music, minimalist design, and a carefully engineered atmosphere that made work feel aspirational at exactly the right moment. After the 2008 financial crisis, millions of people were moving into freelance work, startups, and flexible employment. Traditional office leases felt outdated. WeWork felt modern. By 2014, the company was already valued at $5 billion. By 2016, that number reached nearly $17 billion. Then came SoftBank. Its founder, Masayoshi Son, believed WeWork could become a global platform company, not just a landlord. SoftBank invested aggressively, and the money changed everything. By January 2019, WeWork's valuation hit $47 billion. The company operated in more than 100 cities. It had over 500 locations worldwide. Revenue reached $1.8 billion in 2018. The company signed massive long-term leases across New York, London, Shanghai, and San Francisco. At its peak, WeWork managed more office space in Manhattan than almost any private company in the city. But the most important thing wasn't the real estate. It was the narrative. WeWork convinced investors it was a technology company, not a leasing company. That distinction changed everything, because technology companies get valued for future scalability. Real estate companies get valued for cash flow. And for years, investors believed the story. But by 2018, the cracks were already forming. The company was growing fast, too fast. Every new WeWork location required enormous upfront spending, long-term lease commitments, construction costs, interior redesign, marketing, staffing. The company was signing leases that lasted 10 to 15 years, but many customers rented desks month to month. That mismatch created a dangerous structural problem. If demand slowed, WeWork would still owe billions in lease payments, and demand was starting to slow. Competition increased. Co-working spaces became common. traditional landlords started offering flexible offices themselves. Meanwhile, losses exploded. In 2018, WeWork lost nearly $1.6 billion. And in just the first half of 2019, losses reached another $1.9 billion. Even worse, investors started questioning Adam Neumann's leadership. Private jets, lavish spending, family members inside the business, personal loans backed by company stock, and bizarre governance structures that gave Neumann overwhelming control. At one point, he reportedly sold the We trademark to the company for nearly $6 million. The company's mission statements became increasingly grandiose. The IPO filing literally referenced elevating the world's consciousness. For the first time, people began asking a dangerous question. Was WeWork actually a technology company? Or was it just an over-leveraged real estate business disguised as a startup? Leadership knew they had to do something. The question was, what? In 2019, WeWork made the biggest bet in the company's history, the IPO. The logic seemed clear. Going public would raise billions in fresh capital. That money could fund global expansion, cover operating losses, and validate the $47 billion valuation. On paper, it made sense. Investors had rewarded growth for years. Uber was public, Lyft was public, money was cheap, and Silicon Valley still believed in scale above profitability. But strategy rarely fails in PowerPoint. It fails in execution. On August 14th, 2019, WeWork released its S-1 filing, and everything changed. Public investors finally saw the numbers private investors had ignored. The filing revealed nearly $2 billion in annual losses, massive lease obligations, weak path to profitability, unusual accounting metrics, and extreme founder control. Adam Neumann held special voting shares that gave him near total authority over the company. His wife, Rebecca Neumann, was reportedly involved in succession planning. The company borrowed heavily while burning cash at extraordinary speed. What had sounded visionary in private meetings suddenly looked reckless in public filings. Analysts were stunned. Some compared the company to a cult. Others questioned whether the business could survive a recession at all. And the more investors read the filing, the worse it got. The valuation target dropped from $47 billion to $20 billion, then to $15 billion, then near $10 billion. Within weeks, confidence evaporated. SoftBank executives reportedly pushed for changes. Board members panicked. And on September 24th, 2019, Adam Neumann stepped down as CEO. The IPO was eventually withdrawn entirely. The company that once symbolized the future of work suddenly looked like one of the biggest startup delusions of the decade. The reaction was immediate and brutal. WeWork's valuation collapsed by more than 80% in a matter of weeks, from $47 billion to roughly $8 billion after SoftBank's emergency rescue deal. Employees watched their stock options become nearly worthless. Layoffs began, expansion projects were canceled, entire business divisions disappeared. Investors who once celebrated WeWork now treated it as a warning sign. SoftBank itself suffered enormous damage. The company eventually wrote down billions tied to its WeWork investment. Even Masayoshi's son later admitted, "It was foolish of me to invest in WeWork. I was wrong." But the deeper problem wasn't just governance. It was the business model itself. WeWork had locked itself into enormous fixed costs during a period of cheap capital and aggressive growth. Then the environment changed. And in 2020, the pandemic hit. Remote work exploded globally. Office demand collapsed. Exactly the scenario WeWork's model was least prepared to survive. The company tried restructuring, closing locations, cutting costs, renegotiating leases. In 2021, WeWork finally went public through a SPAC merger at around a $9 billion valuation. That was still more than 80% below its original peak. But the damage wasn't over. Debt piled up. Occupancy remained unstable. Commercial real estate weakened. And by November 2023, WeWork filed for Chapter 11 bankruptcy protection. The company that once claimed a $47 billion valuation had become a symbol of startup excess. What was meant to redefine work had instead become one of the clearest examples of how narrative can overpower fundamentals until reality hits and hits hard. So what went wrong? It came down to three things. Lesson 1, confusing narrative with economics. First, WeWork confused storytelling with business fundamentals. The company successfully convinced investors it was a technology platform. But its underlying economics looked much closer to traditional real estate. Businesses often confuse valuation momentum with actual durability. And when they do, growth can hide structural weakness for years until markets demand profitability. Lesson 2, incentives can distort reality. Second, the company's incentive structure rewarded expansion above discipline. Private markets encouraged rapid growth. Bigger valuations attracted more investment. More investment funded even faster expansion. That feedback loop made caution feel irrational. Strategy doesn't usually fail because people are stupid. It fails because incentives reward the wrong behavior. Lesson 3, flexibility matters more than vision. Third, WeWork built a rigid cost structure inside a volatile market. Its revenue was flexible, its costs were not. That imbalance became catastrophic during economic stress. Markets don't reward boldness alone. They reward alignment. And WeWork's long-term obligations were completely misaligned with short-term customer behavior. The company wasn't destroyed by one bad quarter. It was destroyed by structural fragility hidden beneath the rapid growth. On August 14th, 2019, WeWork thought it was introducing itself to the public markets. What really happened was a big audit of reality, because once investors stopped listening to the story, they started looking at the core business, and the gap between those two things was enormous. In the end, the real cost wasn't just $40 billion in lost valuation, it was credibility. Because in business, hype can accelerate growth, but eventually, the numbers get a vote.
So that's it. For more business stories, more hidden patterns, like and subscribe to The Firm Lore. And also, don't forget to let us know your opinions in the comment section.